So we thought on a Saturday afternoon, since you are here, we would put some highlights there, and also give an opportunity for people from Paris to join us who are working during the week and want to have fun, as it was just said, with geoeconomics and all of these topics that these days we have fun with, like climate and fracturing. So I'm coming to the topic. Deglobalization is also something that we don't really have fun with, but that we need to understand, and we need to discuss, and we need to see how to approach it. We said initially that this would be about financial deglobalization, but then thought it might be also broader, because fracturing of all sorts of economic systems is what is in scope at the moment. In reaction to, oh yes, this was Richard is here, in reaction to our discussion yesterday about climate, he wrote to me this morning at 6 o'clock in the morning, saying, you did not address the elephant in the room, which is Trump. And I said, yes, Trump, the elephant, is indeed of concern, and we are being concerned with him clearly also in the context of this panel here. I have with me on the panel a fantastic group of people to discuss it. First of all, to my left is Linda Goldberg. She is the financial research advisor at the New York Fed. Previous roles include senior vice president and head of global economic analysis. Linda is well known across the spectrum of international and financial economics. She has been writing, I don't know, I did not count how many papers, but many papers over many years, and many of them very influential publications in the area of international capital flows, banks, etc. And I just realized that you actually have a joint paper from last year with Signe, which is not the reason why we asked Signe to join us here. Signe is the governor of the Danish Central Bank. She is also a CEPR. She is also on the CEPR Board of Trustees, so thank you very much for serving also in that function. And I do say with a certain pride that Signe has a PhD from the Graduate Institute in Geneva and still also serves there as an alumni very intensely. So. And last but not least, Jeromin Zettelmeyer, the director of Bruegel, and another constant in my life, definitely, but I think also in many people's lives through his publications and through all the things that he does. One of them was a Paris report last year, namely on European economic security, which of course touches on these issues, because having to think about European economic security is something that we did not have to do so much for the last 2-3 decades. So with this, let me hand over. Everybody has a chance to deliver some prepared remarks first, and then we have a discussion. Linda, the floor is yours.
Is this on?
Yes.
Okay. So first, a disclaimer, the views are mine and not those of the Federal Reserve Bank of New York or Federal Reserve System. We're in a blackout period. I will not talk about monetary policy either, or elephants in the room. So I'm going to organize my brief opening remarks into 3 parts. First, just for this panel, a little bit of stage setting with arguments not about financial deglobalization, but about financial globalization, because we've talked a lot about globalization over prior decades. Benefits and costs of integration and globalization. Then I'm going to turn to a little bit of evidence to date from different studies, and I'll also mention the international roles of the dollar. And I'll give a couple of remarks on just watch points that maybe we haven't paid as much attention in the research community on. So just in terms of the first, on the benefits and costs of financial integration, these are all reminders, maybe not necessary for this room, but I think it's worth just bringing them back. So the first is financial integration is associated with capital flows and financing investment projects, supporting growth and the efficient allocation of resources. It's also associated with diversification of risks and spreading of giving insurance to spread out the costs of extreme events. And these are, it's also associated with intertemporal savings and consumption decisions being facilitated, financing of fiscal imbalances, in some cases, most cases, lower financing rates than would otherwise be the case, and perhaps longer maturities than otherwise might be available, and with less concentration of bank sovereign dependencies. There also, though, are possibly deeper credit cycles. There are exposures to external risks. These are just the other side of the first set of things that I mentioned. And these are all associated with, of course, the global financial cycle, and when we talk about boom-bust patterns in international capital flows, and more exposure in some cases to exchange rate movements or strains in foreign currency funding markets. So these are kind of context. Some of the negatives that I just mentioned have at least been dampened in the post-global financial crisis period, and some of that dampening of the real effects of some of the drivers of global financial cycles, for example, some large country monetary policies are often mentioned in this context, as well as things like risk sentiment, the VIX or whatever. Some of those effects on the cross-border sense have been damped by improving the risk-absorbing capacity of banking institutions. So bank capitalization is higher, and then amplitude of capital flow responses is accordingly lower. Risk management framework improvements were the focus of bank supervisors worldwide, and global systemically important banks were subject to enhanced recovery and resolution frameworks. And you also had, during this period, expanded facilities of central banks. We've heard about that in some of the sessions here. Improved access to emergency liquidity, think of swap lines and repo facilities, and also domestic liquidity. So let me get to then, that's kind of context setting for this. So what do we know on the financial deglobalization side? I think recent years have focused our research efforts on understanding blocks. And so I think the body of evidence that is emerging by researchers so far is more about fragmentation into blocks than it is about full-scale financial deglobalization. Some of the reasons, and we just heard about that in two of the last sessions, are around attributed to the use of sanctions or economic security arguments being made, or some, and we'll hear more about this, about possible fragmentation in payment networks. So what's the evidence on this? I will just point to 3 studies. Quickly, we're not doing slides. I think none of us are doing slides, so I would normally just have them behind me, but I'll start with the IMF and work of Ayar, Malacrino, and Presbitero. They're all 2024 work. And they have some nice evidence about financial fragmentation, or this block story, as appearing to the greatest extent in foreign direct investment flows. And they have very interesting results about how, if you look at the probability of foreign direct investment between country pairs, And then you rank those country pairs according to their geographic distance from the United States or their geopolitical distance from the United States. You actually see trends in this not just since 2022, but since 2012. And that is that there's more movement towards blocks, much more growth in FDI between geopolitically similar countries than geographically less distant countries. And then the investment flows to friends has continued, but even the post-Russia 2022, the kinds of disruptions that they're reporting on in these types of flows, while it exists, it doesn't take you anywhere near what was observed, for example, in the Cold War periods. There's similar messages on mutual fund cross-border investment flows from Catalan, Fendoglu, and Sunuga. And then from the BIS, Guts von Peter looks at a lot of their statistical collections, and they see that some of the same kind of patterns. They don't do it in terms of the same geopolitical exact definitions. They do West and East in their groups, but I think the message is kind of the same thing, that you have much more sustained cross-border flows between West and West countries than you do between West and East countries, for example. And also that the type of flows matter, which is that if you have, for banks, affiliates that already have been set up in local markets, those type of flows sustain, whereas cross-border flows contract more. So on the international roles of currencies, we've seen a little bit of work here about evidence for Russia, but I think writ large, there's, and this comes from the great work of the ECB on the international role of the Euro reports, which I always plug because it is really great work. They find that the international roles of currencies, and in particular the dollars, and there are many international roles of this, have not changed substantially to date. And so at this point, writ large, there's more talk about financial blocks and talks about threats of financial deglobalization than I think what the evidence is suggesting. I'll just conclude on some watch points. A lot of these comments have been based on volumes data. So volumes of flows, whether it's foreign direct investment, equity, cross-border loans, but not on prices or on co-movements or responsiveness to different types of risk events. And I think focusing on those, what we would call the betas, when things happened, is another area that we could be looking a lot more at. So I'll conclude with that, and then we'll come back later.
Thank you. Thank you, Linda. Signe, it's your turn.
Thank you. Can you hear me? Yeah. Very good. Well, thanks so much, and thanks, Linda, for setting the stage like this. So we do definitely see signs of financial, we can't say deglobalization exactly, but there is some, the speed has come down. I see from Danish point of view, we don't see a lot of signs of these, but it is certainly something that we are expecting will affect us. It is a clear risk scenario, and I thought that I would talk a little bit about taking a very high-level perspective from the view of the central bank. And I am in a central bank in a small open economy which is resource poor, and we are a high-income country, and the prosperity of Denmark has been built on globalization. So that has allowed us to trade, it has allowed us to integrate into global value chains. We've been doing that for the past 40, 50 years. And so this is something that is of key concern to us. It is also, for that reason, something that we pay quite a lot of attention to at the central bank. And I thought I would give you a sense of how. So this is, it is pervasive in all our areas. We have, as many central banks, we have three main mandates. We are concerned with price stability. We have a pegged exchange rate to ensure that. We are concerned with financial stability, and we ensure safe and efficient payments. And I thought I would give you a sense of, in these three areas, how the prospect of financial deglobalization or due economic fragmentation, as has become a household word in the bank, how that's affecting us. If I don't get to the end of this, I would give you my overall conclusion and say that there are definitely risks. It's something that is of great concern. There's risks in all three areas. There are also developments that go in the opposite direction when we look closer to home, when we look to the Nordics, when we look to the EU, and I'm also going to try to stress some of those. On price stability, as I said, geoeconomic fragmentation has become a household name that everybody knows about in the central bank, and that's because we just came out with a study of this area. So what we have been looking at is how fragmentation, very much focused on trade, but finance is going to be also a focus. But how is that going to affect prices? How is that going to affect economic activity in the short term and in the long term? How should we take that into account in our assessment of the economy and on price stability going forward? We've been doing modeling. I think Jeromin will probably say more about those types of models because he's been doing a lot of very similar work that we have been discussing. We have looked at two scenarios, a fragmentation of trade into blocks. As was said very clearly, we're looking at blocks, not a general fragmentation. And we also are increasingly looking at an increase in US tariffs and the different responses to that. And the trade part is something that we already published. Overall, we do find effects of these scenarios. That's also what we would expect. We find them to be stagflationary. They would raise prices in Denmark. They would dampen economic activity. But they are surprisingly modest, depending on a little bit on how fast this happens. If you allow it to happen gradually, we do see quite relatively modest effects. Is that reasonable? Especially given the fact that we do think we have built our prosperity on globalization, wouldn't rolling back also have big effects? I do think that there's a very key role played by the fact that we look at trade blocks, and we still have a lot of trade going on within the blocks. And actually these models maybe underestimate that effect because we're not allowing that part to increase, which it could. We don't have finance and transmission of technology and knowledge in the models. And over time, I think that could be a big drag on growth, which we don't have in there. Just want to finish with saying also that if we add uncertainty to these models, we can also have big effects. But we're not quite sure whether we should be looking at uncertainty in this, if it is an uncertainty issue. Just to finish on, yes, that there could be big effects here. But there are also these countervailing effects that we now have a very strong focus on integration within the EU. After the Draghi and Weder reports, there is focus on the CMU, deeper capital market integration. I know we're going to have a talk on that afterwards, which I'm looking forward to, and also focus on single market. And if we can just get some of that right, that would pull in the other direction. On financial stability, there could be effects on financial stability in both directions, and I think Linda went through a lot of that, so I will not repeat. I just also want to point to an IMF chapter of the GFSR from last year, which looks specifically at financial deglobalization and how that could affect financial stability, with some concerns that could raise volatility and risk and shocks related, for instance, to this lack of insurance when we are more integrated across borders. We have a focus on this very much from a risk perspective at a bank. That means that whatever comes next we could see more volatility, more risks, and that means that we need to have a financial system that is resilient. We need to have well-capitalized banks. Well-capitalized banks, again, I'm stressing what Linda said, that plays a big role. We also need to acknowledge that the financial stability is a global common good. and that we need to have focus on the international financial system and the international financial safety net to support that. And I think that there are two risks also related to geoeconomic fragmentation. That is also fragmentation in global collaboration on financial issues. Ensuring that, for instance, that we are going to go ahead and finalize implementation of Basel III is very important, but requires that we are committed across board. And another thing is that we need to have focus on a well-functioning IMF, which is also can get under strain. So those are the issues on financial stability. Final point on safe and efficient payments. So here, the cross-border dimension is certainly also affected, and it's something that we seem to talk less about, but I'm glad that also it was brought up before. We do see signs of fragmentation also in cross-border payments when we zoom in on bank intermediated payments, which is basically the bulk of global cross-border payments. And we see these signs of fragmentation since the global financial crisis, so it's not a new thing. It has been related to banks slimming their correspondent bank networks because of more concerns of, for instance, AML, KYC concerns. And we have also seen increasing concerns about sanctions. So banks have reduced their correspondent bank networks, and that is very much related to countries that are deemed risky and maybe not worth serving. We do see it at the central bank because we have increasingly been contacted by agents that simply have trouble being able to transfer money to certain places. That means that we do have a shift perhaps into more intransparent transfer networks, for instance, crypto, which we cannot see and which we see as a concern. There are also a lot of initiatives globally on more official initiatives setting up alternative payment solutions, maybe based on types of wholesale CBDCs that can connect across borders, but that will go around the correspondent banking networks. It's still not clear what will come out of that. So there are certainly developments in that area, but I want to finish on an optimistic note, because while there are concerns on fragmentation, there is so much going on in this space. Cross-border payments is developing really fast. I come from a region, the Nordic region, where we have already very fast instant payments within our currency areas. And we are, in fact, in the Nordics already now transitioning to being able to do instant payments on retail level across currencies. It's starting off, so I will not say that we are all enjoying this, but this is coming, the technology is there. Another thing that might not be as well understood is that all the Nordics are currently moving their real-time settlement infrastructures to the target services platform, to use the target services platform of the ECB. So we will, in different speeds now, all be on the same platform, which gives us new possibilities to improve further payments in the European Union. One of the parts of the target services which is really interesting is the TIPS platform, and all this has now been made multi-currency. That means that it was all developed for the euro, but it is now being developed also for the Danish krone, for the Swedish krone. The Swedes are already on. We will be joining the whole target services next year at Easter. And the exciting part is that we already have the project of going from multi-currency to cross-currency. That means that we will soon have the ability to do real-time gross settlement of retail payments on the TIPS platform across currencies cheaply and efficiently. And this is really around the corner, so it is coming. Another thing that is speeding this up is that we have the Instant Payments Directive in the EU, which is coming online. It's going to be enforced in force in 2025. So that will push along the reach of instant payments in the European Union. So I do think that this is quite exciting, and this is moving very fast. And the fragmentation that we otherwise see is, of course, something that counters that, but there are both forces at play. So let me stop here and just say that, yes, there are potential negative consequences of financial deglobalization coming along. There are risks, but there are also, when we look closer to home, countervailing tendencies that we should keep an eye on, we should support. So I will stop here and let you take over.
Thank you very much, Jeromin.
Thank you so much. Bea made it clear to me that since I'm the only non-central banker on this panel, it's going to be my job to talk about the less financial parts of the topic, and possibly even about the elephant in the room. So let me just tell you how I look at it. So for me, what we have seen, roughly since 2015, 2016, and now much more massively in the last 6 months, very much feels like we're on a way to return to the 1930s, right? So protectionism is rampant, authoritarian or illiberal political models or policy styles are very attractive to large segments of the population, even in sort of established democracies. We have nativism, anti-immigrant sentiment, we have disregard for multilateral agreements of rules, WTO, Paris Agreement. So it really looks like this could be a sea change, right? After 80 years of multilateralism, we could be going back to somewhere which we really don't think is collectively optimal. There's also some evidence on fragmentation, but not a whole lot, right? So this is what Linda said on FDI. There's the US-China trade decoupling, but there's no real evidence of deglobalization yet, right? So trade remains very high as a share of global GDP. It's no longer growing, but it's up there. The dollar is by and large maintaining its international role, and effective trade barriers and tariff levels remain low, with the exception of US versus China. And so for me, the really interesting question is what are the conditions under which all these sort of bad vibes that we are feeling will actually turn into deglobalization. So when does it stop being a matter of style and bluster? And when do we actually go back to the 1930s in terms of currency wars, tariff wars, unfettered economic nationalism? Okay, so to derive a question, I'm going to take you through like a few steps. So to derive an answer, I'm sorry. The first step is an observation, which I think is quite important, which is that the surge of protectionism, or more broadly economic nationalism, so when I talk about economic nationalism, I mean not just with respect to trade measures, but also discriminatory industrial policy, potential competition policy that tries to push national champions, withdrawal from international agreements. All these are facets of economic nationalism that were typical for the 1930s. So the surge of this new economic nationalism is particularly in advanced countries. And it's particularly in the United States. And more recently, and to a lesser extent, in the EU, and you can see this in the trade alert data that were quoted by Pierre-Olivier Gouin-Chasse yesterday. You can also see it in a beautiful new report by the EBRD. I don't know if Beata is still here or not, but they have a new transition report that's on industrial policy. They have an overview chapter, chapter 1, where they document not only that the increase in industrial policy measures is quite drastic. It starts around 2010, and that it's predominantly in advanced country, but also that about 80 or 90% of these industrial policy measures are discriminatory by design. So they cannot be, if you like, derived or excused entirely from the desire to expand the role of the state versus the market, which most of us would have some sympathies with, given what happened in the global financial crisis, but they are specifically nationalist. They're there to support the home team against the foreign team. Now, the fact that this is going on in a country like the United States is prima facie surprising. And the reason why this is because the main historic argument for economic nationalism is to allow countries that are coming from behind to catch up with the technological frontier, right? So the guy who invented economic nationalism, modern economic nationalism, Alexander Hamilton, had a very sophisticated argument for it, right? And it was simply that in the presence of the overwhelming dominance of the British Empire over manufacturing internationally, there was no other way for the United States to catch up than through subsidies and in some extent tariffs. And this argument has been very powerful. It has fueled economic nationalism and to some extent justified it in developing countries throughout history. What is really historically unique is that the frontier country resorts to economic nationalism of this style given catch-up from the rest. So, for example, it did not happen in the 19th century, right? So the 19th century, I speak under the control of Alan and other historians that are here, we saw something that is vaguely resembles what the catch-up of China now, right? Back then, the UK was at the frontier. The catch-up countries were Germany, the US, and to a lesser extent Japan. They were massive users of protectionism and economic nationalism. The UK did not react by jumping on the bandwagon and taking this even further. The UK simply stayed put. Now, maybe this was a mistake, I don't know, but it is notable that the present historical moment is quite different. So, why is it so different? So I'm going to give you 3 stories, and they all have to do with the historical origins or historical arguments for the rise of protectionism in the United States. And so basically there were 3. If you look, so this is based on Doug Irwin's History of Trade Policy on the United States and some other work on historic economic nationalism that has come out in the last few years. So there are basically three stories. The first one is the Hamiltonian developmental economic nationalism, which turned out to be not very persuasive to Hamilton's contemporaries. It was not originally picked up. The second is an economic security argument. So this has to do with the experience of the Napoleonic Wars, to which the US reacted by blockading, by having a trade embargo with the UK, and it did terrible. It was a disaster. And so after that, Jefferson, who was president at the time and who was very much an anti-economic nationalist originally, he was a free trader, sort of embraced this idea that the US had to reduce dependence on foreign demand by building its manufacturing industry, and that was the initial reason why tariffs became popular in the US. And then you have a third wave of protectionist sentiment, and this has to do with industrialization in the UK in the 1840s, with the squalor of the working class in places like Manchester, and sort of the sense in the US that there would be a race to the bottom if the US emulated this. And so it was, at the same time feared by the industrialists in Pennsylvania that the consequence would be essentially communism or the labor movement making headway in the US. And so protection was, in the common interest, if you like, of industrialists and workers, or it was at least presented as being in the interests of workers. So one way of thinking about this is protectionism is a response, a tradition-rich historical US response to a social cohesion problem coming from foreign competition. And so all of these 3 play a role, I think, in what we're seeing right now. So you can argue, and in fact, the argument has been made. So you have, literally infant industry protection arguments being made in advanced countries, including, by the way, documents of the European Commission, that, yeah, fine, we are not infant, but these new industries are infant, and they require protection. And so the interesting thing, it wasn't made back then, 100 years ago. It is being made now. Why is that? I presume it's because China is just so massive and so threatening. So the leapfrogging of the US by China is just, in some sense, more dramatic, or potentially more dramatic, than the leapfrogging of the UK by Germany and other countries back then. The second argument is, of course, economic security, which is particularly strong now. The third argument is, again, social cohesion, right? It's the way in which both Biden and Trump have been attempting to keep this drifting of a part of America between the beneficiaries of globalization and the losers. 2 more points, then I'm done. So the first is that this story explains, to some extent, why the resurgence of economic nationalism has not been observed in the EU to quite the same extent. So we are not competing with China militarily. We have stronger and fiscal and labor market mechanisms for maintaining social cohesion, so we don't need to resort to tariffs quite so soon, and we have in the past benefited from China's growth. But this last point is now really over, and so the fears of social and economic turmoil as a consequence of losing, for example, the EV race with China are just as high as in the US, right? So what we're feeling now in a place like Germany is, in a sense, sort of a sense of foreboding that, you know, the NAFTA shock, the China shock, and what it did to US manufacturing is about to happen here. And you can see the consequences of this in the fact that the EU mainstream, that is both in Brussels, but also the Draghi report to some extent, has embraced protectionism to a significant degree. They don't always say it, but you know, the Draghi report argues for an EU version of Bidenomics, including local content requirements, which are illegal under WTO law. Okay, so then the final essential question, you know, what does it take to, you know, basically tip the international system? So far, you know, most WTO rules are being complied with in spite of all this. And I think there are basically two important things. The first is how the EU, as the one large trading bloc that is still observing the rules, behaves, right? So we are large enough, I think, to have an impact on the system. And this is why I'm very concerned that you know, our compliance with these rules is no longer taken for granted. The Draghi report does not say, let's maximize industrial policy subject to keeping the international rules. It says, let's have a trade policy be an instrument of industrial policy. And then the other really important thing is of course, what happens in the US, and whether the US economic nationalism manages to somehow parse its reaction to China as a country that allegedly deserves this treatment because it has not observed the rules itself, with the behavior towards everyone else and the maintenance of some rules versus everyone else, right? And so in that sense, the next few years will be essential. So will the US behave as if there were sort of a rules-based system in place that is closer to the US tastes and discriminates specifically against China, but allows the US to maintain a truce with the rest of the world that maintains or contains a broad tariff war or not, right? And that's where the jury is out. Thank you.
All right. Thank you very much to the three of you. I'm going to resist asking my own question, just to note a few things that I have written down here during your remarks. We are, interestingly enough, still in a situation where the evidence is not quite as bad as our fears. And however, we've been there for a while. I mean, the talk about deglobalization starting with trade, where somebody like Richard Baldwin has been saying for the longest time, you know, it's in the newspapers, but not in the data. And maybe a bit more we're seeing there now. We're seeing things shifting around, at least. But somehow the elephant has not manifested itself, really. And the question is, you know, are our fears maybe overblown, or are we really close to a tipping point, Jeromin, as you put it? Is there something like a point where things start going wrong together at the same time and in an accelerated way? I thought it was very interesting that you compared the China shock story for the US with the kind of shock psychologically and industrially speaking that Germany is going through right now. And of course, it's not only Germany. We're speaking about the machine cluster in Europe, and that extends beyond Germany. So let me open the floor for questions. I'm sure there are many, starting with Richard. Yes, there is a microphone coming.
Fascinating discussion. Thanks to the panelists. Just a few points, some questions. One, I totally agree with Linda. International currency story, U.S. dollar declining, blah, blah, blah. There's a lot of blah, blah, blah. There's little change and not likely to be much change for some time. The talk of BRICS currencies and all that stuff is just a lot of talk. The second point is about the data, and I think here the ECB has done something very useful over quite a number of years now in its financial integration review when they show price data versus quantity data over time, indices of financial integration. And they're quite different. And I think we should pay attention to that there are different ways of looking at these things, and we shouldn't ignore as I say, the difference between looking at what the price data say and what the quantity data say. A third point is about financial stability, and I think here we tend to, I think we've underestimated the nature of the lessons of the Eurozone crisis, and that, I think, the key one was that these big cross-border capital flows that took place in the Eurozone after the Euro came in were inherently destabilizing because they overwhelmed the capacity of the financial intermediation system to deal with them. And that is something I think we have to be looking at for the emerging market countries too. That we've had a lot of stuff from the IMF about capital controls and so on and so forth, but I don't think there's been enough emphasis on the potentially destabilizing effect of excessive financial integration, if you like, and that's because the domestic financial integration, the financial systems just can't take it. And finally, I was very interested in what Signe said about cross-border payments and so forth. I think if I take literally what you said, why are we thinking about this central bank digital, CBDCs, excuse me, who needs it, right? And that's one question that comes out. But the second question is, what do you see possibly the role of stablecoins in international transactions, given your experience and the way that things have developed in the Nordic area? Thank you.
Thank you. Let's have a few questions. I saw Luis and Eric, and then we'll do a second round. They're here in the middle.
I'm not so sure it's so benign.
Please use the microphone. We have people online.
To be a bit pessimistic, I'm not sure it's so benign, Richard. If you look at some developments such as renminbi invoicing of oil trade, in some cases, or people having preferences for renminbi assets, swap lines in renminbi for some emerging markets and the PBOC. So my question is, yes, of course, fragmentation, what was ported as a way to back to the 30s. But so as an example, who exactly can tell me who had this idea of, or did the cost-benefit analysis of weaponizing the US dollar, and, for example, weaponizing the payments, international payments system, and what sort of rationale was done to sort of add to the difficulties that the panel pointed out, these little elements that maybe constitute a tipping point for what you are describing as a sort of a process of going towards more fragmentation. And after all, if you hit this nerve, this is perhaps a sort of an element of mistrust and has some potential for irreversible effects in the international payments system if you sort of go towards weaponizing some of the pillars of payment systems and international trading and financial currency.
Okay. One more. I had, I think Eric had a question, yes or no. So I would have said it was Russia, right? But I leave it to Linda to answer.
So I think we have some ideas for why in the real so in trade, or particularly foreign direct investment and and global value chains, we haven't seen as much change that we would have expected from all the talk. And a theory there is that the forces that are driving these global value chains are so powerful, and the type of trade that goes within these global value chains are very dependent on individuals and so on, and the transfer of information through that. The question is, on the financial side, do we have similar forces that just pushes efficiency towards certain forms of transaction, and that there is a lot of, in the end, human components in these trades, and that is the counter effect that is a reason for why we haven't seen this elephant manifest itself so far. And if that is the case, are some of those changes that Signe, for example, alluded to in terms of technologies, maybe changing that so that we are actually shifting away from those maybe more personalized type of exchanges to something different?
Thank you. So shall we just go in the same order? If you pick on any of the questions we want to answer.
My personal views, and so just a couple of comments on the US dollar's roles. So I'll start by saying that there is a lot of language that's used around US dollar status and policy that I think suggests a lot of negative intent. And so words like hegemon, dollar dominance, weaponization, these get a lot of play in some circles. Those I actually don't agree with those terms. So in terms of, they all suggest there's some kind of power play that the U.S. is doing in having it making a choice for the world and using currency. So I think there are a lot of good reasons that U.S. dollars are used in international transactions, like liquidity, safe haven roles of the dollar, and so forth. I mean, this has been well researched. On the weaponization comment, things like financial sanctions, for the most part, are joint financial sanctions. If you look at the financial sanctions that the U.S. has imposed in the last, let's say, the financial sanctions the U.S. has imposed in the last 15 years, the vast majority of those are joint with other countries, and they're not specific to U.S. dollars. So even the kind of SWIFT network, SWIFT is a multi-currency platform. So I just don't even agree with the premise that this is about U.S. dollars specifically, but the rhetoric, even when it's, and we saw this in earlier presentations today too, even when it's a joint action, it's considered a U.S. action. And I think as economists, we should be moving away from that. So that's my comment on that one.
Signe, do you want to
Yes.
pick up on something?
I would certainly want to pick up on something. So thanks a lot for very good questions. A few things to Richard. On the financial stability issue, that we should learn the lessons from the EU crisis, and maybe also for EM countries, I can only agree. But I think it's not just for EMs, it's also something that we need to keep an eye on today, because there is, during good times, also always a tendency for it to be difficult to keep up on not weakening regulation and of banks. And so I think it's really important that we keep our eye on the ball on that, also in the current times. And there is it is quite remarkable how well the banking sector has been faring in the last couple of 3-4 years in light of all the shocks that we have been exposed to. And that just also adds to a risk that we need to keep mind of. On cross-border payments, the question on CBDC, I will let central banks and governments that are working on CBDCs to answer for that, but there are many other reasons to develop CBDCs than efficient payments, and so I will not comment more on that. Role of stable coins. We see now that there is a pickup in payments that come through crypto. If it's stable coins or other types, it's very difficult for us to observe it because we don't have a lot of transparency. So it's very hard to predict what will come of that. There is a lot of talk and presentations around using crypto-based structures also for payment settlement, for instance. And I hear a lot about the advantages, but it's still hard for me to see the actual, first of all, driving business models, and also to see it happening. So I think it's still very hard to predict, and the jury will still be out on the role of stablecoins. Just as an aside, it's not just stablecoins that are being discussed in these, because if we set up settlement structures that are based on crypto, we do need some settlement asset in those structures. And one asset could be tokenized bank deposits, and then we're simply back to a bank-based model on a different platform. And let me just say one thing about Eric's comment. I think that's a very interesting comment. If we are switching to different technologies, of course, that will also disrupt the people that are involved. We will go to different personalities that have different networks, and it's very likely that will somehow disrupt also the status quo. So I think it's a very interesting perspective.
This is more a question than an answer. So on the disagreement, ever so slight, between Louise and Richard. So there's a lot of evidence presented actually here at this conference yesterday that the invoicing currency of Russian imports has switched towards the yuan in particular. Exactly. So what? But I'm not aware of evidence that the invoicing currency of Chinese trade to non-sanctioned countries, right, third parties, EU, has been affected. Does anyone know anything about this? It seems to be a Russia sanctions story of directly. You will have that in 6 months' time. Okay, thank you. We'll look forward to it. This was Arno from the European Central Bank.
Okay. Yes, David, yes. Next, and
could I
there was
make a very brief and unexpected plea for political science here to build on what Jeromin has said. The world we've lived it's important as political scientists say to think of what was established after the Second World War as a world order. The Bretton Woods system, the GATT, the UN system, everything together with interconnections between that order. The second point, the trouble with most political scientists is that they set out to give essentially a political explanation of why that order was established. And the arch spokesman, wonderful work by John Eikenberry from Princeton, making that argument. But I think the most interesting third line of argument is Jonathan Kirshner from Boston College, that this world order had an economic underpinning. The sort of caricature version of it is that the British, who were the declining hegemon, were building a welfare state, which whatever the damage to them done by American policy, they supported because there was a sense that all collectively shared in the benefit of what was being made. Now, the Kirshner argument is that that's what happened in the US, that the phrase they use is embedded liberalism, and there's a study of how and why this worked in the US after the war, and the sort of caricature argument as to why how it stopped working is that the median real income of the median family wage earner in the US hasn't risen for the last 35 years. That's the end of embedded liberalism. And the Kirchner argument is when that ends, the support of that hegemon country for the global order is so undermined that it can't continue to do what it did when it established the order. So I think it's worth making a connection thank you, between the political underpinnings of what's going on and the particular discussions that we're having about particular areas of trade and finance in this conversation. Thanks very much.
Thank you. And then there was over here, Rolf, yes, microphone coming. And then we take it back to the, oh, was there more? Okay.
Ferdinando.
Oh, okay, all right. Okay.
So thank you very much. Just short observation and then 2 questions. The observation is we have at the ESM done some work actually on the fragmentation, financial fragmentation. Indeed, you can also find for Europe a pattern of fragmentation in financial flows and also a clear impact when it comes to financial uncertainty, how it affects those flows depending on political alignment or not, and then that affects portfolio investment. So that is just by way of stylized facts. The question to Signe a bit, you didn't want to fully answer, but I mean, the international payment system and the system of corresponding banks is now weaker than before, but it has always been horribly inefficient and expensive, or very inefficient and expensive. Why is there not a stronger push of central banks towards having a better functioning system, and should now really be the movement or new technologies derail from such an objective? And a question to Jeromin, I did not understand what in your view would be the best strategy now for Europe. I mean, stick to the rules if you can. First, try to negotiate with the US because retaliation is more expensive. If you cannot, try to turn to China and threaten the US that you may turn to China and insist on fair trade, but then it's still more open. So what is, in your view, the dominant strategy to be done?
Okay, thank you. 2 over, please. Yeah.
Thank you. So just one point linked to this. I think there are things happening with invoicing and paying in renminbi. It's in the third world. It's not big enough yet, but let's not have a European-centric view here. In Mauritius and in the Indian regions, there are things happening with China, and they are rolling a couple of things. It's not big yet, but if we think in 10, 15 years, 20 years, it may give another picture. A second point, I think, about this discussion also, what we are calling here deglobalization, isn't it somewhere or somehow an issue of dislocation of the Western group? Because what's here at play is a risk of divorce between EU and the US. And on sanctions, we've seen French banks heavily sanctioned in the US on the base of using the dollar or etc. So, and we've have some data also at the OECD showing that there are massive subsidies. And not only in China. They are huge in China, but they are also huge somewhere else. And so there is a weakening of the, level playing field. So all this, I guess maybe Mr. Zettelmeyer will tell us, is that the risk, and so and how to avoid that risk? Thank you.
And then there was Patrick here.
Question really for Linda. Mentioned that the data on deglobalization are moving into blocks. The extent to which there has been a decline dates back to 2012 or before. My perception is that this is not so much geopolitical as the weakness of the banks and the or extra regulation on the banks after the global financial crisis, that they just retreat to their home base. We saw the Americans doing this out of China. We saw the French and other European banks from the US and from the Far East. So that this is not a geopolitical story, but a global financial crisis story.
Okay, so last round of answers. Any that you feel maybe we'll do it in reverse order?
So on the European strategy, so I would basically take the Draghi report with 2 modifications. I would stay within WTO rules and not flirt with local content requirements and things like that. And my approach to industrial policy would be more focused and less biased in the direction of supporting incumbents and energy-intensive industry, where we probably need some structural change. And by doing that, we would probably reduce energy prices quicker, and then we would be able to keep a larger share of our less energy-intensive manufacturing industry. And then with respect to specifically to the tariff Trump threat, I think we need a credible and massive retaliation threat. It should be about publishing a negative list, so we should retaliate across the board with the exception of a few areas where it's not clearly not, it would not be credible to do it, and then conditional on that, we should try to negotiate. And that then leaves the most difficult question as to what extent should Trump shift our views on China and our cooperation with China. And here my view is that in the climate area we should simply cooperate. In FDI we should basically invite them in areas that are not about critical infrastructure.
On inefficient corresponding banking networks, historically, it is deeply unsatisfactory. I'm completely in agreement with you. I think we need to ask a political scientist why we haven't addressed it, because I do think we need to look back at institutional, historical reasons. We have had banking-based systems, which means that cross-border transactions have also been bank-based. And then we have national governments that set the rules. And there is surely an element of coordination failure. So I think that the answer would be quite complex. Just one comment on that, and that I think that it is not that we're lacking the technology for making a better system. We would be able to do that. The challenge is really in the rules, the regulations, KYC, AML. You need to know your customers, and then the coordination amongst national governments, national supervisors on making this happen. Because technology is moving so fast, there is a lot of work in that space now, and that also brings on different actors, as Eric also pointed to, onto the space of payments that are asking questions about the rules and regulations. And so there is a lot of stuff going on, and we will see where that is leading us to.
Okay, so maybe 3 points. So I think, Bea, you mentioned talk versus effects earlier, and Rolf mentioned the impact of uncertainty on flows and portfolio investments. So I do want to point out something that hasn't really come up in today's panel on uncertainty, and that is in some of my research on U.S. bank lending activity, and I'll come back to Patrick's point too. Trade uncertainty is associated with credit supply contraction. So basically, if you have kind of talk that, makes firms, banks, whatever, uncertain about the value of some of their assets, then they will kind of contract not just to targeted players, but more broadly. So you could have real effects of rhetoric more broadly without even implementing the policies, and some of these can be highly distorting or contractionary. In terms of what happened post-GFC on the banking side, I think it's worth pointing out a couple of things there. One, and this goes back to these points about bank capitalization, the more weakly capitalized banks, some of which were large in international lending activity, contracted the most after the global financial crisis. And some of the better capitalized banking systems, even, for example, Canada, expanded their international activity while banks from countries like Germany contracted. So there was a reallocation of activity, and there continues to be risk migration across banking institutions. But the other thing that's really important in the last 10 years is that international debt issuance, so securitization, has become more important in financing a lot of non-bank borrowers throughout the world, and more important across emerging markets than even bank lending. So these are some of these technological changes that are going on, and some of these regulatory induced and supervisory policy induced shifts that really kind of change the profile of what happens when shocks occur. And at the same time, some of it is potentially reinforcing some of this blocking, but the evidence is mixed on that. And I guess the last point that I just want to make maybe is on related to the role of the dollar, and again relating that to the fragmentation and the geopolitical issues, which is that one of the discussion points that you also hear out there about the decline of the roles of the U.S. dollars is its use in foreign exchange reserve portfolios. Because if you look at global aggregates, the IMF COFR data, the dollar share, for example, from 2015 through 2021 declined. So I've looked at some of the evidence on what's happening in country portfolio allocations and the share of dollars. And it seems that there is a role for geopolitical distance from the United States in those allocations. But it's actually not what you might think ex ante. And that is that on average, geopolitically distant countries from the U.S. have a higher share of dollars in their portfolios, not a lower share. And I think that occurs because for countries, they hold reserves for liquidity purposes. And so you want to have high liquidity in your portfolios. And when the geopolitical distance really kicks in is when countries have high enough reserves to excess reserves in a way, in excess of their liquidity needs. So in all of these things, there could be tipping points, and there could be a lot of dynamics that are surprising to us.
All right, thank you very much. This was a fantastic set of discussions, which are obviously not over. In fact, we are just about to embark on a big natural experiment with the elephant who must not be named. But I did want to sort of pick up on one thing that Signe said. Denmark is a small open economy. Well, so is almost everybody else. The EU as such may not be small, and within there are a few middle-sized countries, but every other country is small, open, and has benefited almost certainly over the last decades from the globalization. And I do find it an interesting puzzle that in our models, generally speaking, not only in the data, but also in the forecasts, the deglobalization usually is not a huge, sort of the impacts of deglobalization are estimated to be relatively smaller than we think the benefits have been of globalization. You heard a variant of that yesterday with David Dorn, who was talking, on the one hand side, has a very important paper on the impact of the China shock on US manufacturing employment, large, and then the decoupling part of that after the trade war, the employment effects relatively small. So I think it's an interesting puzzle, and obviously not only food for thought and further research, but also, as I said, we will have more data points soon.